What I'm going to do in this video is briefly go over how to set up an option strategy. My example stock is going to be 3M. And this is after market close. It's 228 right now. And you're going to track this based on closing prices. Let's go over the strategy first. This is the option strategy finder. The link is on the directions for this assignment. We're interested in bullish trading strategies. Click on search here. And what I'm going to do is a bull call spread. So we'll click on that to look at the details of it. The idea here is that we're going to long an option here at 40 or be long on an option here at the low strike price, and then we're going to sell an option here at the high strike price. And by selling this option at the high, it's going to reduce our net exposure. The basic idea is you want to buy an at-the-money call option and simultaneously write some higher strike priced call option for the same security in the same month of expiration. All right. What it's going to do, this is the payoff diagram, assuming we hold it until the end. It cost me a certain amount of money to buy the option. I get back a certain amount of money from the option that I sell. Where this lower price is usually one of the at the call or at the money options. So if I look at my option chart here for call options, again the price is 139.29. So my at the money is either going to be 139 or 140. I'm always going to be interested in my highest volume option here. So this is 162. We're traded today. We're on the 139.4. So these are the two options I'm interested in. The 139 is trading at $3.25. The 140 is trading at basically $2. All right. The selection of one of these versus the other one is more the art of finance than the mathematics of finance. I will say that the intrinsic value of the option at 39 is only 29 cents, so I'm paying an awful lot for 29 cents of intrinsic value at 325. For the 140 option to get money, I need to get it up there, about 71 cents, which is a reasonable move in any given day. So I'm going to do is the 140 with $2 strike price, this guy right here. Strike is at 140. And again, this is the June of 2014 option. It's they're going to expire on Friday, June 13th. All right, so I'm long that call. That means it's going to cost me $2. Come over here to my Excel spreadsheet. This is today the 6th. So the one I want to long is costing me $2. I'm just going to enter the price on that one. We'll go ahead and make sure that we have pennies incorporated here. So that's what I bought into this call option at. Now the one I want to short, we come back here to our option trading strategy. The higher the strike price that I picked the short of, the greater my upside profit. On the other hand, the less expensive that option is going to be. Therefore, when I sell it, the less money I'm going to get. So if we come back here to our option sheets, we can see that if I go up to say 145, I'm getting 56 cents for the option. And if I go up to 150, I'm getting about 12 cents for the option. Or I'm sorry, 20 cents for the option. This price right here. It'd be nice if there was something a little more in the middle, like a 147.50, which may actually be out there. But I'm just going to make the decisions here. So I'm going to go with this 145 with a price of 56 cents. We'll come back here to our spreadsheet, and the short call is going to be 56 cents being short. Actually, probably a more basic way to do this is, since I'm buying this one, that's money going away, and since I'm selling this one, that's money coming to me. Alright, so the next thing we'll do is that for each one of these days, after the end of trading, we'll come in and pick up the closing price of my long call and my short call. And what we want to see, actually, let me do this. Let's go back to the positives. So what we want to see is that the stock price moves up. When the stock price moves up, my long call here is going to go up in value. That's the thing I own. And my short call is also going to go up in value, but it's not going to go up by as much. So right now, the total cost of investment is just the sum of these guys. And that's per share. So it cost me $1.44 per share, or $144 to get into this strategy, and then we'll see whether it works or not. Obviously, if the stock price goes down, I've lost all my $144. I hold these until expiration. If the stock price goes down or stays just right at where it is right now, under 140, every day each one of these options will become less valuable, and I'll lose all my money. So one of the things that you also want to look at is, well, how, compare this to actually buying the stock. Merge these cells together, make things a little more followable. So if I would have actually bought the stock, I'm here at 139.29. So if the stock goes down by $1.44, buying the stock is the equivalent of doing this bull spread. I've lost $1.44 on my bull spread, or I've lost $1.44 on my stock. If the stock goes down by less than $1.44, then it would have been better for me just to buy the stock. On the other hand, if the stock goes up significantly, suppose it goes from 139 up to 160 over this period, unlikely but possible, then it would be better just to buy the stock, because the most that I'm going to make here on this spread is going to be roughly $5 a share. So again, by doing the bull spread, you're limiting your upside potential. On the other hand, you're doing 100 shares. This is based on 100 shares for $144 versus $13,929, or $13,929 to buy 100 shares of stock. So less expensive, but at the same time, more risk. Okay. Another one you're going to be interested on, this is in the write-up, is we want to go to SPY, and everybody's going to have to do this one to track. So here's my spider. Go into our options, and what we're going to do here is a collar. And again, we want the June option strategy. I'm sorry, we don't want a collar, we want a straddle. So we'll just back off here. We can look at all options. And a guts and a straddle are similar. Option strangle, strangle is what we're looking for. So in this one, we're going to long a call, we're going to long a put that are going to be slightly off the current price. So the closing price was 186.78. from way down here for our calls. So it was at 176. Yeah, well, no, 186.78. So I got a 186.50 that's in the money. We'd probably do, say, 185.50. Again, we're interested in the one with the highest number. In fact, let's just do the 185 call. So we long a 195 call. I'm sorry. My mistake. I was thinking puts. We want to go up a little bit higher. So we're going to long a 187.50 or make it a 188 call. So this is the one with the highest volume associated with it. This is the call that we're going to be going for. So it would cost us $2.53 for that. And then we're going to long a put that's also out of the money. And our out of the money puts, we would be symmetric, roughly speaking. So we're at 186, we're $3 or so above. We want to be $3 or so below. That would be a 183 put. So here's our 183 puts, or you might pick a 183.50. And we're interested in the one with the 183 with the highest volume associated with it, which is this guy right here, and that would be the put that we would pick on. So you long the put, you long the call. This is a volatility bet. We look up here on our strangle. If prices decrease, we make money. If prices increase, we make money. And if prices stay pretty much in here, we're going to ultimately end up losing money. All right, so that's the strangle that everybody's going to need to do. We'll talk briefly about the other material in class later. And what you'll have to do is find out what your final profit was. So on this last day, you're going to get out. The long that you paid $2 for, you'll sell for whatever it's worth. The short, you'll buy back for whatever it's worth. And you'll take the change in price of the call. Suppose the call goes up, just as an example, to 550, and that the short goes up to $2. Go ahead and format this one too. Okay, so our bonus here is going to be what we got for it minus what we paid for it. And just drag that across. All right. So our net